When you hear that a government is quietly changing the rules around silver, what is your first instinct? Most people check the price. That is the wrong question. The right question is why a government would bother rewriting customs codes, import duty schedules, and reporting thresholds for a metal that most of their citizens do. Not think about it all. Governments do not rewrite tax law for markets that do not matter to them. If silver rules are moving quietly right now, it is because something underneath the price has already changed, and by the time it shows up in a headline, the positioning is usually already over. Stay with me for the next few minutes because the mechanism behind this is more important than any single number I am about to give you. As of Thursday, July 23, 2026, silver is trading near $58.77 an ounce, down slightly on the day but still up more than 50% from a year ago. Gold is holding above $4,100 an ounce, and the gold-to-silver ratio has broken below 70, a level it rarely stays under for long. The backdrop is not calm. Houthi forces have struck tankers in the Red Sea. President Trump has warned of strikes on Iranian infrastructure if traffic through the Strait of Hormuz is threatened, and the Federal Reserve meets next week with markets expecting rates held steady rather than cut. Into that backdrop, three governments have quietly rewritten how silver moves across their borders. India cut its import duty on silver bullion from 15% to 6%, then restricted imports of plain silver jewelry under a separate customs code requiring a license from the Directorate General of Foreign Trade. China added silver to a controlled export list alongside rare earth minerals late last year, and in the United States, dealers are enforcing 1099B reporting on any accumulated sale of 1,000 ounces or more from a single seller, a threshold most stackers do not realize applies across multiple small purchases, not just one large one. Here is why this is happening, and you need to understand it as a chain, not as three unrelated headlines. Think of a national silver market as a sealed container with a single pressure valve. Step 1, price rises sharply, and India's silver imports for the last fiscal year hit roughly $12 billion, up from $4.8 billion the year before, with April alone showing a 157% year-over-year surge. That kind of volume does not just reflect investment demand, it starts to threaten a country's foreign exchange reserves, because every ounce imported is currency leaving the system. Step 2, and this only makes sense once you understand Step 1, a government facing reserve pressure has exactly two tools: raise the cost of entry, or restrict the volume of entry. India did both, cutting the bullion duty to ease legitimate industrial and investment flow, while simultaneously restricting finished jewelry imports through licensing, because that route was reportedly being used to mislabel raw silver as finished goods and dodge the higher duty through trade agreement loopholes. Step 3, before we get to the consequence, we need to understand the cause behind China's move. China placed silver alongside rare earths on a controlled export list, which is not a tax change. It is a strategic supply chain decision, and it tells you Beijing now treats silver as materially important to its industrial and technology base, not just as a monetary metal. Step 4, the consequence. Once two of the world's largest silver-consuming and producing nations start treating cross-border silver flow as a policy lever rather than an afterthought, every other jurisdiction watches and adjusts, which is exactly what is happening with U.S. dealer reporting enforcement tightening around that one. 0.00 ounce aggregation threshold. The valve is closing in multiple places at once, and each closure changes the pressure everywhere else in the system. Here is what most analysis is missing. Nearly every video and article on this topic frames these changes as a price story. More scarcity equals higher price, and that is not wrong, but it is incomplete. According to tax analysis compiled by Minted Metal, the U.S. capital gains rate on physical silver held over a year sits at 28% under its classification as a collectible, and that rate does not get offset by sales tax already paid at purchase, meaning your real friction cost is sales tax plus premium plus 28%. On the back end, layered on top of whatever compliance burden the new reporting thresholds create. Almost nobody is talking about the fact that regulatory tightening does not just affect the price you can get, it affects the percentage of that price you actually keep, and that number has been quietly getting worse in multiple countries at the same time the scarcity narrative has been getting louder, if you are still with me at this point. You are exactly the kind of viewer this channel is built for, someone who wants the mechanism, not the headline. That is precisely why staying subscribed matters here, because these rule changes tend to compound in ways that are easy to miss if you are only checking back in when the price makes news. The next regulatory shift, whether it is another country adjusting duty schedules or a change to reporting thresholds, is far more useful to know about before it is priced in than after. I read the comments on these videos, and the conversation there often sharpens the analysis more than the script does. Now, before we get to how this could unfold, I want you to sit with a distinction. There is a version of you that holds silver because you have done the math on total cost of ownership. You know your effective break even after premium, tax, and reporting friction, and you have a defined reason for holding that would change if the underlying thesis broke. And there is a version of you that is holding because the price went up, the stacking community feels good, and you have not actually calculated what percentage of a future sale you would keep after every layer of friction currently being built by these rule changes. Neither version is wrong to own silver, but only one of them is. Making a decision, the other is writing a feeling, and the honest way to find out which one you are is to sit down and actually calculate your real after-tax, after-friction return at today's rules, not the rules you assume still apply. From here, there are two paths worth watching closely. In the first scenario, regulatory tightening accelerates. More countries follow the India and China pattern of using licensing and export classification as policy tools. Middle East tensions stay elevated into the Fed's decision next week, and safe haven demand combines with genuine supply friction to push silver toward the $65 to $80 range, though a meaningful share of that gain gets absorbed by the widening tax and compliance gap we just discussed. In the second scenario, the Fed signals a clearer path toward cuts, the Strait of Hormuz situation de-escalates, and governments that tightened rules during the price spike begin loosening them the way India already loosened its bullion duty, in which case silver could settle back into the $45 to $50 range as urgency drains out of the market alongside the regulatory pressure. We will not know which path is unfolding from price alone. Watch the Fed statement next week, watch whether India revisits its jewelry import restriction, and watch whether any G7 country follows China's lead on export classification, because those decisions, not the daily chart, are what will tell us which scenario is actually playing out. I am not going to tell you which one is more likely, because anyone who tells you that with confidence right now is guessing. Here is the deeper question I want to leave you with. If a government can redefine with a single administrative order what counts as your silver, how it must be reported, and how much of its value belongs to you after the fact, what does ownership actually mean to you? Is it the metal in your hand, or is it the set of rules a state has agreed, for now, to let you keep it under? Leave your answer in the comments. I read them, and the conversation that question tends to generate is often more valuable than the video itself. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.